For those of you that don't know, I was vice chairman of the NASDAQ stock market, and then in tilting at windmills, I got very interested in, I was there during the course of what we call the bubble rubble, affectionately, which was the aftermath in 2001, 2, 3, 4, when stocks or companies were getting delisted left, right, and center. I think David Rose talked about the number of listed companies in the United States as being 5,000. We're going to give you some data, but do you realize that at one point we had closer to 10,000 listed companies in the United States? Okay? So I just want you to think about that delta there and the impact of that. And it's not because of an accelerated rate of companies going out of business. It's because we haven't gotten enough companies into the public markets. And I'll tell you, we're going to walk through why. So what we're trying to do is to actually fix that problem. It's one of these, if you will, regulatory issues that ultimately led to some unintended consequences in the stock market that I think is impeding access to capital for entrepreneurs. And I've sort of made it my life's work to try and fix this problem, one of a series of problems. Now, for you, this is the title. If you Google me, it's kind of interesting. One of my friends, who's not too gracious, has called me the grandfather of the Jobs Act, and I'm not that old. So I just want to put up that if you Google me or Google the father of the Jobs Act, you'll see me come up. If you Google grandfather of the Jobs Act, I won't come up. So I'm happy with that. Tech is disrupting finance. We think that it's actually that regulatory change is now enabling technology to disrupt finance in this country. And so, a number of the people that were on the last panel, as you can see, have businesses now that were enabled by the Jobs Act, which was signed into law by President Obama on April 5th of 2012. And one of the titles in particular gave birth or enabled a company like Crowdfunding and Chance Barnett, which was Title II of the Jobs Act and the repeal of the prohibition against general solicitation. Which, by the way, was a recommendation, and I'll show you where you can get it, that was lifted out of a paper that we wrote back in, show you the wheels of progress grind very slowly, in 2009, called A Wake-Up Call for America. And I'm going to walk you through a little bit of the data. But before we do that, there's been a lot of regulatory change over the last 20 years that's affected stock markets, and a lot of it has really undermined capital formation and access to capital for entrepreneurs. Now, you think about hyper-efficient, low-cost trading. It's not a wonderful thing for small capitalization companies because low-cost trading basically relies on letting the orders in the market, symmetrical order book stock markets, interact. They're innately liquid stocks. But when you get down to micro-cap, small-cap, private market stocks, they're innately illiquid. Big buyer, no seller. Big seller, no buyer. And there has to be an economic model and a methodology to go out and create a new order to offset a seller or a new order to offset a buyer. And that was something that the old NASDAQ sort of big spread, high commission markets did exceptionally well, which is I could buy a stock at $10 a share. Okay, I could mark it up and put a quarter in it because I had a buy recommendation on it. And my brokers could get out there and create new buyers, sell that stock, market that stock when that asymmetrical big seller came into the market and there was no naturally offsetting buyer. We manufactured liquidity. That was gutted when we started to create these low-cost, hyper-efficient electronic stock markets. Another one that's creating negative impact, and the easiest thing to understand is, everybody looks at there's $3 trillion worth of exchange-traded funds in the world now, all sorts of index funds. Well, think about something. It's that sort of Pac-Man's up total equity value in the world, liquid equity value. There's nobody home in those funds to actually buy stocks from an offering, to put capital into the coffers of the treasury of a company so that entrepreneurs can put that capital to work and create jobs. So, one of the things that I would love everybody in this room to think about is as we're creating all this wonderful capability, exponential finance, Moore's Law, data, interconnectivity through the internet, it empowers folks, but some of these things are going to be massively disruptive. And we're going to have to worry about, I think there was earlier today somebody said that something like the 40% of all service sector jobs are going to go kaput because of what we're doing with artificial intelligence. Well, that has just profound implications for stability in economies and people's sense of self and so on and so forth. And if we can't engineer our way through those problems, you know, watch out for the sort of the so-called advances that we're unleashing through our engineers and our scientists. Sarbanes-Oxley increased costs. That was back in 2002. Investment advisors actually replaced, I mean, think about it, it's fee whack-a-mole. Everybody thinks we saved all this money from retail investors, yet what happened on Wall Street is the brokers still got paid. They just became investment advisors, and instead of charging commissions and marketing stocks and bonds, they took a percentage of assets under management, and they got paid that way. So now they just accumulate assets, and they do asset allocation. The downside to small capitalization companies is that you don't have 100,000 brokers in the United States any longer out there marketing your small cap stocks, creating that information effect. So one good thing, and I think this was done by the Division of Corporation Finance at the SEC, was that they brought in shelf registrations, and so increasingly you can access capital very cost effectively from a permanently live, if you will, registration statement and sell that stock into the marketplace, raise capital. And so for bigger companies, the market in some respects, once you're public, has actually become a little bit more efficient. Let's see if I can move this along here. So again, lots of negative relations. So what we did was we just sort of, some people said I was tilting at windmills for a while, and my father actually called me Don Quixote at one point. He said, does anybody care about what you're doing? So we wrote a whole series of thought leadership pieces starting back in about 2007. And literally at the time, we were talking about health care, that we were having the Obamacare debates in Washington, and it was impossible to get anybody to pay attention. So we honed our craft, we simplified what we were doing, and we basically said, you know, look, guys, throughput is way down. We're doing 165 IPOs, and I know Mike Milken just talked about how the IPO market's better, but better compared to what? I mean, it's better compared to the credit crisis. But I mean, if you think about it, he said we did last year 188 operating company IPOs. So let's look at real C Corp IPOs, okay? We were doing 500 IPOs on a smaller economy per year in the 5 years before the dot-com bubble, okay? We wrote a paper for the OECD, Organization of Economic Cooperation and Development, and in that paper, okay, we basically said that the number of IPOs the United States should be doing, if we hadn't changed market structure, okay, comparing apples to apples off of a bigger GDP base, is about 600 to 1,200 a year, or an average of 900. So that delta, we believe, the difference between what we should be doing, 900 a year versus 165, we think that's 10 million jobs to the U.S. economy. Okay, think about that. Now, how do you get there? Well, economists will tell you that there's 2 to 3 million jobs directly, and then you can read a book like by somebody, some of the economists talk about a multiplier effect in job formation. And so Professor Enrico Moretti, who's a professor at the University of California at Berkeley, wrote a book called The New Geography of Jobs, and in it he says that there's potentially 5 service sector jobs created for every technology job that's created in the economy. Interesting. So 5 times 2 million to 3 million jobs is 10 to 15 million jobs lost to the U.S. economy because of the implosion in capital formation. So we tried to socialize some of what we saw going on, and I, you know, having been vice chairman of the NASDAQ stock market in the 4 years basically after the dot-com bubble, what I affectionately call the bubble rubble, we were delisting stocks at a hellacious rate, and we weren't bringing in enough stocks, so it was pretty simple to kind of understand the level of carnage that was going on. And so, you know, we ended up working on a series of things and floating a whole range of ideas because we weren't sort of prescient, clairvoyant enough to understand what people would have an appetite to do. So we said, we don't care if you fix it and you create viable stock markets and private markets and redefine them, or public markets. And we ended up with crowdfunding under Title II. Title I of the Jobs Act allows you to do confidential filings. It creates a new category of public company called an emerging growth company, up to $1 billion in revenues. If you're hanging around tonight, I'll tell you the backstory about how we got to $1 billion in revenue. And it allows you to actually go out and meet with institutional investors if you're a company tracking to go public, which is really important for a heavy IP company, biotechnology, technology, semiconductor, because now you can meet with these institutions. You don't have to shut the marketing process down before you go public. They can internalize the story, kick the tires, understand the technology, and they're much apt to be a long-term investor, because the notion that somebody's going to make a $5 million 5-year investment on the basis of one 45-minute meeting and an IPO roadshow is just crazy. I mean, no real investor invests that way. And then finally, Reg A Plus, that we still haven't seen rules on, but it's a sort of an exemption, if you will, somewhere between public and private offerings. It's actually an exemption from registration, and this was to show the provenance. It actually started with the old General Counsel, Steve Mochtinger of Hambrecht and Quist, who noticed that there was a seldom used provision in the securities codes, marked it up, gave it to Bill Hambrecht. Bill Hambrecht gave it to Paul Pelosi Jr., who was his best friend, who then walked it into Nancy Pelosi, who you all know, who then gave it to Barney Frank, who at the time was the chairman of the House Financial Services Committee. And when the Democrats lost the control of the House, it ended up going over to a fellow named David Schweikert. It was H.R. 1070. He stewarded it in as a Republican. It was bipartisan. And then when Eric Cantor actually came up with the idea of creating an omnibus bill, which was wrapping together a whole series of bills, it ended up as Title IV of the Jobs Act. This should ultimately allow us to have a less expensive way of getting companies public. It's sort of IPO light, up to $50 million in proceeds. The problem is that it's not going to fix the aftermarket support model. So I'm just going to call your attention. This is our website. It's issueworks.com, not an advertisement. There's a button there on thought leadership. And we have all of the papers that led to the Jobs Act, our testimony in Congress, if you have any kind of an interest in sort of really, really digging deeply into that particular subject. We believe passionately that innovation, which comes from education and perspiration, hard work, and access to capital are sort of the paths ultimately to improving quality of life long term. And so if you undermine any of these things, and we have done that with regulatory changes in the United States, that it starts to create bottlenecks, which in turn stifles the growth in the U.S. economy. So, you know, I wanted to take a couple. This is going back to what Samir had said, that if you look at a whole series of different industries, there is enormous potential in all of these industries to do good if we can start to figure out how to remove the bottlenecks. So access to capital, there is the societal concern about investor protection. If we can address investor protection in a way that will get Congress and the SEC comfortable and the consumer groups comfortable, and then we can improve access to capital. One of the reasons why Title III, which is public crowdfunding, was dead on arrival is it was dubbed by a renowned professor of law from Columbia College of Law. It was dubbed the Boiler Room Act of 2011 in the U.S. Senate. Got everybody very concerned, and so they made some changes to public company crowdfunding, and now it's essentially dead on arrival. Actually, the original sponsor of that bill is Congressman Patrick McHenry. Actually recently introduced a replacement bill, and we'll see if that flies to try and actually ginny it up. My view, and I had this conversation with that professor of law, is that if you think back to the concerns about peer-to-peer auction markets years ago, and you fast forward, you'll understand that eBay did a phenomenal job with the crowd of sussing out fraud, and that it thrived because it did an absolutely wonderful job for its customers. And I believe that ultimately the fears around crowdfunding are somewhat misplaced because it'll be a bit Darwinian. It'll be the crowdfunding portals that do a great job for investors that are ultimately the ones that thrive and become, if you will, the eBays of the crowdfunding world. And so in some respects, I think one of the best things that regulators can do is to understand that there has been a paradigm shift in these markets, that there is an enormous power of the crowd that ultimately can be put to work in the investment space as well. Side effects in drug development. I mean, clearly, if you are looking at pharmaceuticals, the public policy concern there is side effects. So we can't randomly go out and be more aggressive, if you will, on clinical trials. Privacy, patient records is the concern, massive amounts of information. I'm going to go a little bit over here, I apologize, but a couple of things I wanted to drive you through some of the data. This is IPO success rates going back to the early 1990s. They've been in secular decline. The scary part is that the deal sizes have been getting bigger and the companies are more mature. And the reason for it is we're going through, you can see there's cyclicality going through. This is trailing 30 IPOs. You can see that it's been a steady downward trend. We think that that's due to the chronic undermarketing of smaller capitalization stocks. This was an actual slide that was an earlier rendition of which was put up in the House Financial Services Subcommittee on Capital Markets. And what it is all the way on the left is 1991, on the right is 2012, I believe. And the green tranche is smaller than $50 million IPOs. And they fell off a cliff in 1998, which was 3 years before decimalization, 4 years before Sarbanes-Oxley. And the reason they did was because that was the point that we converted to electronic stock markets and we started to gut the economic incentives for brokers to get on the phone and market. And it's never recovered. And in fact, if you look at 2013, 11.5% of all IPOs were sub $50 million in size. That used to represent 80% of the IPO market in the United States. So this is the round trip going back to the early 1970s of listed companies, and you can see that we grew up until 1997, 98 when these changes were implemented into the stock market, and we've now done a round trip. The fascinating thing is that if you just put a regression on the upslope, that we actually would be looking at, instead of 5,000 publicly listed companies today, we'd be looking at 13,000. Think about that. So the important thing is ultimately to break the bottlenecks, and for me, the reason why I'm so passionate about this is that I don't think that Americans and Chinese are very good at showing self-restraint. I don't have a lot of confidence in our ability with the Kyoto Accords to cut global warming, but I do have a lot of confidence in the ability of technologists and innovators to go out there and solve many of these problems. And so I think that getting capital into the hands of people to break down these barriers and getting people interested in reinventing the social structures that go back 100 years in many instances, that this is absolutely critical, because we're going to a world that has 7 and then 10 billion people in it. And that's going to put enormous pressure in terms of global warming, pollution, the need for renewable energy, and ultimately the transmission of disease. I am over time. I'm going to just skip to the very tail end here, but I will tell you that there is the potential, using technology, to really cut through a lot of the time that it takes entrepreneurs to raise money and to improve the allocation of capital. And I think that if we're able to do that as a society, that this is going to be one of the great enablers of forward progress. And so with that, I'm going to say thank you.
Okay. Thank you so much, David.